Looking at the past year, the stock market was up 25%. If you could afford 5 seconds for a tap and a swipe, you could have invested $1,000 in an index fund a year ago, and now you will have $1,250. Imagine you have put in more. 2K, 5K. That just shows investing early is the way to go. Lucky for me, my money was not sitting in cash, but invested in some good companies a few years ago. And now my Robinhood portfolio has surpassed 300K. In the past year, it was up 29% versus 25% from index fund. It's not beating the market by a whole lot, but if it keeps beating it by 4% every year, I'm going to have 30% more gain after I graduate from college again in 4 years. No way I'm doing that again. But what I will do in the next 15 minutes is to use the most user-friendly language to go over my consumer product-centric Robinhood portfolio. So follow along, I'm sure you will learn something insightful. Now grab your favorite drink and let's get back to the text! I don't know what just happened. Let's get into it, y'all. Good morning, everyone. My name is Justin. I'm a designer working in the Bay Area. I design consumer products, so I crafted my Robinhood portfolio in the same space because I understand consumer products better and I'm interested in them, which makes it very easy for me to spend time studying those companies. Since now you have the context, let's dive right into chapter 1. What exactly is in this 300K portfolio? So this is the most up-to-date. I have some options that I saw cover calls on, especially, or some PMCC. And well, stocks and ETFs, let's just go by one. ASML, VRT, Booking, APP, FNG. I'm just going to skip those because they're nothing. I'm just keeping track of them. So the first one is Dell. I have 101 shares. It's currently down 10%, down like 1.2K. This is meant to be like a short-term AI play. Like in the past year, I bought it around this time. I should have exited, but I didn't when it was like 170. While looking at the latest earnings report, it's still growing double digits with a strong backlog. So I'm not too worried about that. I'm just gonna wait for it to go up and then exit it. So next is Chipotle. I have 148 shares, now up almost $200. Well, if you look at the past year, I bought it about around this area, like 57. It went up and down. I just didn't buy enough of the dip, and now it's back to this similar area again. I started buying Chipotle because I see that as like a great place to grab a quick bite that is not too unhealthy and not too expensive. And when I was there, there's always a line. There's some seasonal items that taste delicious, and the avocado then just makes you happy. They still have room to grow, I think, and I'll just keep buying. And as you can see, I do have a $52 call on Chipotle, and when it expires in March, I'm just gonna exercise it. Next is Autozone. I have 7 shares, currently up 15%, about $3,000. And if you look at the 5-year chart, it's just beautiful uptrend. I started buying AutoZone because I discovered that DIY car fixing culture. You get the parts from AutoZone, you fix up your car, you feel great about fixing it, and then you feel like your car runs even better now. Classic IKEA effect, and people just keep doing it. Next up, we have Williams-Sonoma, which I have 128 shares, currently up 38%, about $7,000. I started buying Williams-Sonoma because I do a lot of window shopping. I go to Williams-Sonoma, which sells mostly kitchenware. They also own Pottery Barns and West Elm, which sell furniture. Their products are just so high-end, luxurious, posh. When you see it, when you feel it, you feel warm, you feel cozy, you feel very homey. So it's like everybody's dream place to shop and fill it up into their dream house. Next, we have FICO, which I have 8 shares, up 63%, about $6,000. I bought this about 2 years ago, and I started buying it because I discovered FICO keeps showing up on my bank apps. Let's see if we can find it. See? FICO score. I also found out when you apply for a loan to buy a house or car, you need to get an official FICO score to prove to the bank that you are likely to pay the loan back. FICO charges you money for giving you the score, and most importantly, this is actually legally required. It means FICO is blessed by the government. Next, we have Costco. I have 17 shares, now up 14%. And I started buying it because I realized how fun, incredibly fun, is it to just go through Costco. It's huge space with so many aisles, so many different items. Every aisle is an adventure on its own. And they're all in great deal. The recent expansion to Asia, like China, Japan, is genius, pure genius. Well, I'm Asian, so I know how much Asians love, no, obsessed with a great deal. And there are a lot of Chinese people, a lot of Japanese people. Look at this headline, look at this photo, look at the line. It's ridiculous. So Costco is a buy for me. Next up, we have Tesla. I have 200 shares, up 100%, 41K. Of course, there's some luck to it, but I started buying it because I see so many Tesla in the Bay Area. Not the right sample size, but you get the idea. However, I am planning to fully exit Tesla because my discounted cash flow model on Tesla does not seem to add up. And I'm going to wait for the full self-driving revenue really started to come in and convert to cash flow. There will be still opportunities to buy when it comes. Which also explains why I sold a 250 and 240 call, and they're now deep in the money. So they will get called, they will get exited at some point. Next up, we have Airbnb. I have 102 shares, currently down about 8%, down 1.1k. I started buying because I heavily bet on this designer CEO. He understands users, he listened to users, he made a Twitter poll to ask about features they should develop. He's also really good at rallying his troops to create, imagine new experiences, and craft beautiful products that people love. I think they will do well, it just takes time to show. Next, we have Netflix. It's chill. I have 3 shares because it run up too quickly and I couldn't buy enough. I'm up 4%, about $100. I started buying after I realized how many Netflix shows that I've watched with my housemates and how Netflix shows became part of the culture. Bridgerton's Emily in Paris. And after I started paying for the ads tier. If you ever seen their ads, it's getting very creative. When you pause on a show, it actually shows an ad, which is so clever, and the ad looks good. It has great layout. My only complaint is that it confuses people a bit because the ad is of course way bigger than the post of the show, and the post of the show is no longer in the show landscape format, so it feels a little bit disconnected, like I didn't even know, oh, that was where I came from. So if I were to tweak it for a bit, I will keep the same pulse screen, keep it landscape, and give people a better anchor so they know that's way to go back. Design thinking. Next is Google. I have 125 shares, up 24%, about 4.8k. I started buying after I realized how many people are using Google products every day, me included. Google Maps, Chrome, YouTube, Google Flights, you name it. And next, Meta Platforms, formerly Facebook. I have 34 shares, up about 23%, about 4k. I started buying after I realized I have been using Instagram, Facebook, WhatsApp every day to talk to all of my friends all over the world. Plus all the recent brain rots, Instagram reels that keeps me awake at 1 in the morning. Still, their apps are very polished, very smooth, very easy to interact with good layout that keeps the interaction very clear and very light. Next, Apple. I have 59 shares, up 23%, 2.5k. I started buying actually a long time ago. I don't have that many shares left because I've been trading options and some of them get called. I should really just chop my hands off so I don't touch it anymore. Apple is kind of a no-brainer for me. They're a design company. I'm a designer. They make very compelling products. When you own them, you feel superior, you feel sexy, you feel luxurious, and everything just feels so elegant in its own Apple ecosystem. I am curious about the next product though, so just keep buying over time and we'll see about that. Next up, we have Broadcom. I have 147 shares, up 118%, up $18,000. This is a great win, to be honest. I started buying because it's a recommendation from a friend and a former housemate. And I also found out they provide Bluetooth Wi-Fi chips for Apple. No wonder why the AirDrop works so well. They're also working with Apple on their new AI server chips, so a lot to come. I call this a consumer product infrastructure company because they don't exactly sell anything to the consumers. But when I see an iPhone, I know, oh, there's Broadcom chip in it. When I see a Wi-Fi router, oh, I know the Broadcom chip is in it. Next, we have Nvidia. Look at the chart, it's beautiful. But I only have 12 shares, up 7%, $100. I realize that it's a good company way too late. But again, I bought it for the same reason, consumer product infrastructure. When I use Chat GPT, Meta AI, or Autopilot, I know, Nvidia chip was behind it. They help train AI models. Yeah, so that's all the holdings I have, core holdings. And some of them do pay dividends. So in a total, if I sum up for 2024, it's about $1,600 in dividends. It's pretty good. They outperform not because they make beautiful consumer products that millions of people use. This collection works because these companies have great business fundamentals. Using Terry Smith's framework to outperform the market long term, the 5 metrics of your portfolio needs to be better than the metrics of the market. Return on capital employed, gross margin, operating margin, cash conversion, and interest cover. He has been beating the market since 2010, 600% versus 400%. He could do that because the metrics of his portfolio has been consistently better than those of the S&P 500. I updated the numbers for my companies and did an average on it. This is how my portfolio stacked against the S&P. If it's green, it means it's better than the one in S&P. Individually, not every company is perfect. Like Costco, Chipotle, for example, they're not going to have super high, super great gross margin and operating margin because that's the nature of their business. Wholesales and restaurants, they're just not the same as luxury goods and software sales. But they're still growing free cash flow, they're predictable, so it's okay, I'm going to keep them. Even though most of the time I just keep buying, I did have a lot of trades in 2024. Way more than I wanted, to be honest. But still, let's go to chapter 2 and see some of the most notable trades that I've made in 2024. So let's see, we have buy, sell, option. This one is worth calling out. Hershey's. So Hershey's is a great company to begin with. If you look at those metrics, it's above VOO in many ways. But the stock has been down because the cocoa price stays pretty high, driving down their margins. I saw that as an opportunity, so I bought a 175 Hershey's call. And one day there's a potential buyout of Hershey's news came out. The stock just spiked up in a day. I sold the call with a $1,000 profit. According to Wall Street Bets, if it's good enough to screenshot, it's good enough to sell. Next is my PMCCs. My Airbnb PMCC, it was down, so I sold it for a loss. My Nike and Nvidia PMCC are still here. Both of them are not doing well. So there are 2 learnings here. 1, your trading works until it doesn't. And number 2, even though I try to use the poor man's cover call strategy, I am still a poor man. Notable trade number 3, I sold all my VOO, all my index fund. I sold it because I don't need to keep an index fund to see the money weighted return. I can just do it on portfolio visualizer backtest.com. I also sold it because I'm going to put that money into a better ETF. So those are the 3 main changes or highlight in the past. Now let's move into the future to chapter 3. There are a few stocks I'm watching. Number 1 is AppLovin. They are an advertising company, game company, mostly ads for games. I play this tennis game on my phone from time to time and look at the ad. It's likely one of those that AppLovin does. Next is ASML. I would say this is another consumer product infrastructure company. They make the machines that make the chips that Nvidia and Broadcom design. Next is VRT. It's a recommendation from a friend of mine. They do a lot of power and thermal management for data centers, which is what enables cloud services and AI training. So essentially, Vertiv make cloud services and AI training run smoothly and uninterruptedly. There's also one mysterious ETF. It's mysterious because I'm still trying to figure out, and I will do more research and report back. In terms of executions for all my existing stocks, I'm just going to keep buying every 2 weeks when I get paid. I'm going to sell Dell and Tesla like I just mentioned. And I'm thinking also selling some of my holdings, not all, but like trim some of it, if the valuation of those companies get way too detached from their business fundamentals. This is something that I learned, the difference between active investing and passive investing. If you manage your money actively, it's okay to trim if that company gets a little bit too overvalued. Then use that money to buy another undervalued stock. If you do passive investing, index fund, you can just let it rip and don't have to touch it at all. With options, I will just keep selling calls, weekly calls, monthly calls, which you can see here. Possibly I will do some PMCC, just small amount with Hershey's again, Nike. I still think they're going to come back, and Vertiv. Looking at the cash position, what I'm going to do with this is holy 75k cash. That is high, like triple mushroom high. It's like 22% cash position. But I also just found out Warren Buffett keeps a 30% cash position. So who is high now? I have so much cash because I have an educational guess. There will be some sort of 10% corrections in 2025. Some companies will be on discount, so I can use that cash to scoop up some shares. I'm not a quant analyst, so my reason for this is obviously very naive and simplistic. The rolling 10-year Schiller PE is as high as the mini tech bubble in 2022, meaning the market is at a high price. There's more headwind than tailwind. It cannot keep going up forever. It has to go down to go up. I don't know when it's going to go down. I don't know by how much, but I think it's going to happen in 2025, which you probably already know that because it's some kind of common knowledge. So what's the point? It's the same as I'm saying my mom is a woman. The ocean has water. Therefore, it's probably not a good idea to listen to me and just inverse every intuition that you have. But maybe it sounds so pointless that it might just be right. Nobody knows. Maybe this guy will know. Just pay a visit to find out. Or you might just go on Wall Street Bet and trade options and have some fun. Speaking of trading options, I will see you all in these videos. Cheers!